Hello and welcome back. So this is video number 4, the 4th section of Mastering Private Equity, where we're stepping back from individual deals and taking a look at the institutional architecture that powers private equity. This section really explores the relationship between general partners, the fund managers, and the limited partners, the capital providers, the institutional investors. This GP-LP model is the backbone of the private equity industry and what has ultimately allowed it to scale globally. It's also a complex and evolving relationship with legal structures, incentive structures, performance pressures, and occasionally with breakdowns. So let's walk through the fund life cycle from fund formation to wind down. Chapter 16 looks at fund formation. And it starts with how private equity funds are ultimately structured. The most common setup is a closed-end, limited partnership, a blind pool, with the GP managing the fund and the LPs contributing the capital. This model creates legal clarity, economic alignment, but it's not simple. Fund documents like the LPA, the Limited Partnership Agreement, spell out governance, fees, profit sharing, including the famous carry or carried interest, and obviously investor rights. Now, standards have emerged over time, but every LPA still needs to be negotiated, which is why firms like Debevoise and Plimpton are super busy. Formation stage sets the ground rules, and if done right, it builds trust and discipline for the years ahead. As you can see here on the slide on the fund formation, you see basically GP-LP structure on the left side. Obviously, nowadays, we still have co-investment vehicles, some parallel funds. We will mention later on when we talk about secondaries, continuation funds, and all those literally have to play ultimately hand in hand to ensure that whatever the GP does is aligned with the interest of the LPs. Now, let's have a look at fundraising. It's more than just pitching and collecting dollars. It's about building long-term relationships in private equity with those LPs who may ultimately back not only the fund you're raising for right now, but multiple fund vintages. GPs do need a solid track record, a clear strategy, and increasingly strong ESG credentials, and the reputation of adding more than just dollars to their portfolio companies, the value creation element. LPs from pension funds to sovereign wealth funds are doing deep diligence. Fundraising involves several key steps: preparing the private placement memorandum, the PPM, organizing a data room, securing an anchor investor, and running a tightly managed process. As we heard from various private equity firms, speed ultimately matters, and so does transparency. Getting to a close quickly and cleanly is clearly a competitive advantage and sends the right signal to the market. Let's go to chapter 18, LP portfolio management. From the LP side, managing a private equity portfolio is not as easy as it sounds, especially if you're used to the clarity of public equity and fixed income investing. It is both art and science. So it starts with deciding how much out of total AUM to allocate to private capital. Then selecting fund managers across geographies, across strategies, and more often than not, across vintages. Diversification is key, but so is also the access to top-tier GPs, which ultimately is only guaranteed when one allocates consistently. Once invested, LPs need to monitor performance, ensure liquidity, and need to pace themselves when it comes to drawdowns. How much capital is being called, and when will distributions ultimately arrive? How much do we need to bridge those time gaps between capital returned and new money being called? Large institutions like CPPIB or GIC often run in-house PE teams. Smaller LPs rely on advisors or even fund of funds. But either way, good portfolio management separates passive capital from strategic capital ultimately. Now, Chapter 19, Performance Measurement and Reporting. Performance in private equity isn't just about IRR. It is really about understanding how that IRR was generated and where alpha was generated. So ultimately, really understanding what IRR in private capital really means. We cover key metrics in the chapter like TVPI, total value to paid in ratio, DPI, a crucial element as I'm recording this right now, distributions to paid in capital, and of course, IRR and all the multiples that basically come with it. Each tells a different part of the story, and each one is as important as the other. But reporting is tricky. Private equity in its nature is illiquid. Valuations are updated only quarterly. So LPs need transparency, consistency, and increasingly real-time dashboards that allow them potentially to get a real sense what's going on the GP side where they're investing. Critical is benchmarking as well. Comparing private equity to public markets using public market equivalent or similar tools. So certain firms have noted in our interviews that clear, honest reporting builds credibility, and it's what brings LPs back for the next fund. So let's jump to Chapter 20, Winding Down a Fund. So what happens when a fund reaches the end of its life, its 10 or 12-year period? In theory, PE funds run for 10 years plus extensions. In practice, many stretch up to 15 years, especially if there are a few, let's call them stubborn assets left. This chapter will explain how funds are dissolved, liquidated, and ultimately terminated. It also walks through tail-end options, extending the fund, in-kind distributions, or ultimately selling the portfolio to a secondary buyer. When things go wrong, we enter the world of zombie funds, old funds managed by GPs who can't raise new funds. LPs in that case may push for fund restructurings, new GPs, or ultimately secondary sales. It is a messy but critical part of the life cycle because ultimately performance is only real when cash is returned. So this was Section 4, a look at the fund level mechanics and the crucial GP-LP partnership that keeps private equity running. In the next and final section, we will explore some new frontiers, from private debt to secondaries to retail investors or permanent capital, evergreen capital, and we will discuss a little bit what the future holds for this industry. So please subscribe to my channel below, and I see you in the next section.